Okay, so we're going to have a go at this question, which is from the January 13 ACCM4 paper. It's a payback and net present value question. Okay, so this question is all about them buying a new machine for £900,000. And what we're told in the question is they're going to sell 32,000 bracelet charms. And we're told the costs of making each bracelet, the variable costs. We're told the selling price, and then we're told some additional information. What we're not told is cash flow, so we're going to have to work those out. All right, so we're going to do that first of all. So make sure you read the question. I've obviously read it already. Just for speed's sake, I'm going to go through it as if you've already read it. All right. If you haven't, pause the video, read the question, come back. All right, so we're going to work out our cash flows. Now, our sales are £55 times 32,000, which gives us 1.76 million. And then we've got our costs. We'll start off with variable costs. So we've got 32,000 times £9.50 and 32,000 times £28.50. Let's work those out. So 32,000 times 32,000 times 9.5 gives me 304,000. That's going to be a negative outflow. And 32,000 times £28.50, which gives me 912, and again a negative outflow of cash. All right, so they're the first ones, but there's a bit of additional information. I've already been through them and ticked them off, apart from that one that you've just seen me tick off, because I've already read the question and I did it automatically. Okay, so it tells us a bit of extra information about further cash flows. Now, the purchase of the new machine is 900,000. That's the original purchase price and isn't calculated within the yearly cash flows. That's the amount we're trying to pay back. So that's the investment price. Next one, machine will last 4 years, depreciated using straight line method. Depreciation isn't a cash expense, so we're not going to include it in our net cash flows. Annual finance costs of the machine will be £260,000. Apologies, just got a delivery. Okay, so where are we up to? Okay, yeah. So the annual finance costs for the purchase of the machine will be £260,000. That is an outflow of cash each and every year. So I'm going to add that to my cost, 260,000. What is that? That was finance cost. All right. Next one I've got is the maintenance of the machine is £20,000 per year. Again, an outflow of cash. What else we got? Insurance is 9,000. Again, outflow of cash. Now, the next two, because I've already read it, they are only for year one. So what I'm just going to really quickly do is work out what the balance is here. So 1760 minus 304,000 minus 912,000 minus 260,000 minus 20,000 minus 9,000. Oh no. No, do that again. 1760 123. See, so always use a calculator. I'm sure you can fast forward through this bit. $255. Okay, so what that tells me is that my year two 3 and 4 cash flows are 255,000. All right. Now, there are those 2 extra. So they are the retraining costs. That is 32,000. And finally, the redundancy costs of 8,000. So that's a further 40,000 to be taken away. So my year 1 costs are £215,000. Oh, sorry, they're both cash flows, not costs. Cash flows. Okay, so now I know my cash flows, I can actually start on the payback and the net present value. So, payback. What I'm trying to pay back is £900,000. All right. So in year 1, my cash flows are £215,000. So 900,000 minus 215 gives me 685. So I've still not paid it back. So I'll need year 2 cash flows of 255. And that gives me 430. So I've still not paid it back. So I need another 255 from year 3. And I'm up to 175. Now, cash flows in year 4 are 255. So at the end of year 3, in the year 4 is my bust year. So, year 4, I require 175,000. And I'm going to divide that by the cash flows for year 4, which are 255. So 175 divided by 255 gives me 0.686275, right? Now, I can then either multiply that by 12 to find out the number of months in year 4, by 52 for weeks, or by 365 for days. I'm going to do it by 12. All right, so times that by 12, and I get 8.235. So I'm going to round that to 2 decimal places. Always round to 2 decimal places. So 8.24 months. So for my payback, my answer is 1, 2, 3 years and 8.24 months. Make sure you're very clear with that so that the examiner knows exactly what your answer is. All right, so that's the payback. So we're now going to do the net present value, which what I'm going to do is I'm going to write out my table. So I'll just do a little table for it. So year, cash flow, discount factor, and net present value. All right, so when you're doing this, start with year 0. And year 0 is the purchase price of the project or asset. So it's 900,000. And the discount factor for that is always 1. So the net present value is exactly the same as the cash flow. All right, because today, if we bought it today, we'd buy it with £1 today, and £1 today is worth £1. So in year 1, remember our cash flows were 215,000. Discount factor in the first year is 0.870. So 215 times 0.87 gives me 187,050. In year 2, my cash flows are 255. Remember, they're different in year 1 to all other years. Discount factor is 0.756. So 255 times 0.756 gives me 192,780. Year 3, again, my cash flows are 255. The discount factor of 0.658. So 255 times 0.658, which equals 167,790. Awesome. And finally, year 4, cash flows again of 255. Discount factor was 0.572. So 255 times 0.572 equals 145,860. So all we've done there is we've converted the cash flows into what they're going to be worth to us in the future by using the cost of capital to find the discount factor, which will always be given in an exam question. And that 255 in year 4 isn't worth 255 at today's prices. It's worth 145,860 at today's prices. So we can then add that up. So 900,000 plus, oh, it's a minus figure, minus obviously. Don't forget that. Always remember it's a minus figure. Plus 187,050 plus 192,780 plus 167,790 plus 145,860 equals minus 206,520. Now make sure at the bottom there you write net present value again, so that the examiner knows that that is your final answer for net present value. You will lose the mark if you don't do that. Okay, finally, you've got to advise the manager if you would buy this or not. Now, the first thing to say is no, definitely don't buy this new machine. And the reason for that is it gives us a negative net present value. All right, so we don't want to do that. And that basically means we're going to make a loss on it over the period. The other reason why I probably wouldn't buy this machine, other than the net present value, if I just use payback, then what I would say is my payback is 3 years, 8.24 months, and the thing's only going to last 4 years. So that would be, again, something to consider. It's not going to even make much after that. In fact, if you were to go 255 divided by 12, which is the cash flows for that final year, we'll divide that by 12 and multiply it by 8.24, we get 175,100. We just make a note of that, 175,100. So that's how much, oh sorry, we've already got the 175, haven't I? So if I went 255 minus the 175, I get 80,000. So it's actually only going to bring you £80,000 worth of cash flows after the payback period anyway. Any other reasons why? Well, yeah, there's loads of reasons why you wouldn't in this question, and this is just basic accounting knowledge. First things I would say is redundancy costs are unnecessary. You don't want to be paying out on redundancy costs, and it could upset your other members of staff. They may lose efficiency. You've got to train your employees. That's quite an expensive amount to pay at £32,000. Are you sure the training is going to work, etc.? Other financial reasons. Are you sure that your materials and labour are going to be £9.50 and £28.50 for the next 4 years? Are they going to remain static? Because we're saying that money's going to change value, so why won't they change value over the next 4 years? So I would definitely be stating that would be an issue as well. Neither of these methods are taken into account depreciation. Payback's really late, and net present value is negative, and we still haven't added in depreciation. All right. So what would it be? Depreciation charge over, you can probably do that in your head, but £225,000 a year depreciation charge on top of a late payback, on top of a negative net present value. It's just looking worse and worse and worse. It's not going to pay itself back quickly, and it won't pay itself back using the net present value method because we end up with a negative figure at the end. All in all, this is not a machine you should purchase. That would be my overall recommendation. All right, so there you go. That is that question done and done.